Alright folks, so we got some exciting news coming out of my favorite real estate investment trust of all time, of course, being Riocan. We have a new CEO stepping in coming next March, in which he just did an interview on BNN that we are going to break down. He will touch base on the dividend security, what the future of retail and office is going to look like, and where Riocan is headed in the current economic situation. Now, before we dive down into that, I want to touch base on some of your biggest concerns over my last video on Riocan, with the number one being, how can you trust a company that has a payout ratio of 533%? Well, the first thing you have to understand is real estate doesn't directly operate like regular businesses. They typically do what we call write-downs, which essentially means they devalue their properties so they can save themselves from having to pay further taxes, but that doesn't directly reflect their actual cash flows. And if you want to know if the dividend is secure, you're actually going to have to come into their most recent balance sheet. And taking a look at the last 6 months, what we directly want to pay attention to here, guys, is their funds from operation, their actual cash flow that they have to pay out in dividends. So the first 6 months of 2020, guys, we can see they had an FFO of 80 cents against the distribution, which was 72 cents. So they do have some bleed room and can actually still afford to pay this dividend. But if we go back to 2019, in the first 6 months, and they brought in 94 cents a share from those funds from operations. Now, this is obviously a concern if they cannot get their funds from operation up, and we keep seeing a bleeding in capital through the rest of the year, but something tells me it's going to be okay. And these are some of the risks you're taking on buying into these REITs. But why Riocan specifically, and why do most investors find it so attractive? Well, it comes down to the current market cap against their underlying assets, because right now Riocan trades for $4.7 billion. And if we take a look, they have an underlying asset of about $15.18 billion as of 2019, and now I think they're hovering around $16 billion in total assets against their total liabilities. So what they owe on debt and everything else is only $6.8 billion, which means if you minus the total assets out of their total liabilities, they actually have an underlying asset value of about $8 billion here, folks. So when you're looking at this market cap of 4.7, you are actually getting a fairly substantial discount. So putting all of that aside, folks, we're going to get into listening to the CEO and what he currently thinks of where Riocan is going. So in the clarity of all the homework I do for you guys, smash that like button and let's jump.
You're stepping in at a time of uncertainty for retail. Oh, I'm not breaking any news there. The units in Riocan have dropped about 50% this year amid investor jitters. I suppose I should ask about the distribution question. I mean, the yield has gone up to about 10%. CIBC says the payout ratio looks high but sustainable. Now, I think this summer you said the management at Riocan said the distribution is secure. How likely is it you'd have to cut that?
You know, we rely thankfully on a lot of the very strong tenants who are performing really well, even in the face of this pandemic, to pay us rent, and they're doing so. And I think that the rent collection numbers that you will see reported from us will be, I think, quite pleasantly surprising to a lot of people. So there are other levers that we have at our disposal. We've got a lot of liquidity, we've got a lot of cash at hand. And so, you know, the distribution is something that we have always held in very high regard, and something that we've always been committed to upholding. But at the end of the day, it's our board's decision. They're going to look at all the options we have. They're going to explore what those options are, and they'll make a determination along with management as to what the appropriate thing to do is. But listen, we'll see what the environment holds. It's an unpredictable environment out there, as you suggest. Retail and a lot of other asset classes are going through some serious disruption right now.
Yeah, so I'm looking at a tenant list for Q2. Canadian Tire was your top tenant, more than 5% of your rent. Then Loblaw and Shoppers, 5%. TJX, aka Winners, another 5%. So they're big blue chip companies that they're not going away anytime soon. So you can't be categorical about the distribution, and I know you just can't be in the nature of things.
That's right. I mean, we've got a lot of strengths at Riocan, and there's a lot that we're planning on building on. And so in order to ensure that we have that we can adhere to our strategy, which is really diversification a little bit, and also strengthening our position in our unbelievable portfolio, whether that's either by rebuilding them or reclassifying some of the tenants that are there right now to make them even more resilient. That's something that obviously requires capital to do, and it's something that we will stick with doing, and we'll always ensure that we have the appropriate amount of capital on hand. But as I said, there's a number of different avenues that we can take to come up with that capital.
In Q2, you collected less than 75% of your billed gross rents, something like 73%. Then there was government funding, short-term deferrals with your blue chip tenants, and that got you up to collections of almost 87% for Q2. Has there been any improvement since then?
We're on a very good trajectory, Andrew. I mean, I don't want to risk selective disclosure, and we will be able to provide a lot more color next week when we release our third quarter results. Through a very, very strong team effort here at Riocan, and really working hand in hand with a lot of our tenants, as well as taking advantage of some of the government programs that have benefited our tenants. We've managed this process really well, in my view, and I think that it will certainly pay dividends for our unit holders. We've been very responsible about it, and we've worked with those tenants that are certainly going through some short-term trouble. We want to make sure that we're protecting those tenants, not only for our business, but really also, I mean, they make up a very important part of the retail and the societal landscape in Canada. So we really want to do our part to make sure that they are sustainable.
Now, of course, we've been talking about retail. That's what Riocan's famed for. But you're also involved in residential, and you've done a lot of work there, and office. Now, I'm thinking about The Well, that big tower in Toronto, that development. Shopify was supposed to occupy nearly 430,000 square feet. As you know, Shopify's been pretty forward about saying no, people can work at home. So that's got to be another problem, the potential loss of office tenants.
Well, we certainly haven't seen that at The Well. Shopify is committed to taking their space. They still do need space, regardless of the proclamation that they no longer need or are relying on office. Something like The Well, which I think will be a very pivotal part of their overall organization in terms of bringing new talent in, recruitment, training, things of that nature, and even the day-to-day operations that are going to be required for running an organization as dynamic as that. And thankfully, they've chosen The Well as that place. And so we feel that their commitment to that building and that development is secure, and they've told us as much. And I think that it's a testament to the fact that it is such a dynamic and important development for the downtown west area.
In 5 years' time, how will Riocan's retail portfolio be different, do you think, Jonathan?
Well, I think that the changes you're going to see, Andrew, are really, we're going to continue on our redevelopment where we take strong, well-positioned, transit-oriented sites that are currently occupied by a building that takes up only about 25% of the land holdings, and we're going to make more of those lands. We'll build mixed-use developments that I think will be pivotal for this city and others like it. And then I think within the centers that we aren't redeveloping, you're going to see some different kinds of uses, some more forward-thinking and innovative uses. You're going to see more micro-fulfillment centers or medical uses or things of that nature that don't necessarily make up the ingredients of a typical retail center. This is what we need to do to evolve our portfolio in a way that will continue to add value for our unit holders. And I think we, with our team and our balance sheet, we're well positioned to do that. But most importantly, these assets are really well positioned in great markets. So I'm very confident in our ability to make the most, to create value from our existing portfolio.
Welcome back, passive income investors alike. So first of all, there are three main points that I want to go over here. And the first one is the dividend security. I'm going to leave the link to this in the description below because he does state that the dividend security primarily comes down to what the board thinks is best for the company's security moving into the future. And obviously that does put that at risk if they don't continue to see a recovery in their bottom line earnings. But he seemed fairly fruitful that coming up on this next earnings report coming next week, which I will break down, he said you're going to be pleasantly surprised. So I'm really crossing my fingers for that. But these are some of the exposed risks that you are taking on in the midst of this pandemic. Now, the second thing by far that I found most interesting here, guys, was their premier property that we're looking at right here called The Well, with one of the largest tenants that they have secured for this new property being Shopify. And there was a ton of concern surrounding whether Shopify was actually going to fall through on that deal because they stated that they can just leave their employees working from home. But luckily they have said that they aren't going anywhere. They plan on taking over that office space. So that is some pretty incredible news. Now, moving forward, and one of the most interesting things this CEO touched base on was basically getting into more essential services, because obviously they're going to have some major issues with some of the tenants that are just getting slaughtered through this pandemic that are probably going to end up filing bankruptcy, in which they said they're actually going to be focused on getting medical-based tenants, which is really interesting, as I'm curious to what kind of medical businesses that they can actually acquire to move into some of these properties where they're already losing those tenants, or heck, even finding them for their new construction builds. It's something that I'm going to be paying attention to, obviously updating you guys as we move forward into the future. But putting all of that aside, guys, I still absolutely love this company. It is one of my largest holdings in my six-figure portfolio, in which tomorrow I'm actually going to do a full portfolio breakdown showing you guys how much of Riocan makes up the total percentage of my dividend stock portfolio. So if that's something you guys want to see, consider subscribing for future updates. And other than that, stay cool, stay awesome, and I look forward to catching you tomorrow.